The purpose of this short video is to give you a brief overview of the IRS bargain sale transaction we're proposing. Enshrined into law by Congress in 1917, there are now over 20,000 of these transactions done annually. In real estate, an IRS bargain sale involves the sale of a property for less than fair market value, typically resulting in a sizable tax reduction for the seller. The cash at closing, combined with substantial tax savings, can make for an attractive offer for the right seller, sometimes exceeding what the seller was willing to accept from a traditional sale. Here's how it works. In a traditional sale, the seller lists their property for an optimal price, let's say $2 million. If that doesn't materialize within the seller's desired time frame, the price is often reduced. Sometimes, due to seller motivation, that price may be reduced several times, well below the fair market value that could be achieved over time. It may be any amount, but let's say for this example that it has been reduced to $1.4 million. Eventually, the seller finally receives an offer within 10 to 20% of their final asking price. Let's say it was $1.2 million. Any depreciation taken on the real estate during ownership must be repaid. This is known as recaptured capital gains and is typically taxed at 25%. For C Corp, it is taxed as income at 35%. For our example, recaptured tax reduces your net proceeds by $100,000. Any profit above the seller's original cost will typically be taxed at the capital gains rate of 20%. In this scenario, net proceeds are reduced by another $140,000. The average state income tax rate that applies is 6.6%. Some are much higher, and some states have none. But in this example, the state would take roughly another $72,000. Finally, the Health Care Act will claim an additional 3.8% of your profits for an approximate $42,000 reduction. What's left after that are your net after-tax proceeds. In this example, that would be about $845,000. Now let's compare that to an IRS bargain sale. First, an independent, certified, typically MAI-designated appraiser will value the property at its true and full fair market value. This may be considerably higher than the price the seller was willing to settle for. For our example, we'll say that the true and full fair market value was, in fact, $2.1 million, just 5% above original list price. The nonprofit buyer will also bring cash to the closing table, but this is usually a minority portion. Let's say it was $200,000. The difference between the full fair market value and the cash contributed is $1.9 million and is fully tax deductible, provided the seller has sufficient tax liability. The top federal tax rate is currently 39.6%. That puts over $752,000 tax-free dollars back in the hands of the seller in the form of tax savings. Add to that an additional $125,400 tax-free dollars from the state. Gross proceeds are now just under $1.1 million. Even on a bargain sale, there is still a tax levied, but due to the low cash at closing, it's much lower. In this example, combined taxes reduce the net proceeds by about $57,000 to roughly just over $1 million. That's a difference in favor of the bargain sale of over $165,000 in this example. The two most important criteria to determine whether this is right for the seller are: 1. The seller must have or anticipate having sufficient tax liability to absorb the deduction. This tax liability can be due to income, profits, or from cashing in a tax-deferred instrument such as a 1031 exchange. In most cases, the seller is limited to a deduction not exceeding 30% of their adjusted gross income. Any unused deduction can be carried forward for up to an additional 5 years. The second criteria is that the appraised fair market value of the property needs to come in higher than what the seller was willing to accept. This typically happens when the seller is not willing to wait for a full market value offer and no longer wants the responsibility or ongoing carrying costs of that property. Our offer to you makes certain assumptions and educated guesses at the tax implications. However, it is not intended to be tax advice, and we encourage you to review the offer with your tax advisor using actual numbers. We can help with that process and will gladly participate in a conference call with all parties involved. For more information to help you determine whether this transaction is right for you and your current property for sale, please reach out to the agent or individual who provided this video. Thank you for your consideration.